Starting with capital structure, one of the most lengthiest and one of the most important topic of financial management. What is capital structure? Capital structure is mix of owners and borrowed fund, where owners fund talks about equity and borrowed talks about debt. How is it calculated? It is calculated as debt upon equity, or it is calculated as debt upon debt plus equity. Now, when we talk about capital structure, there are two major things which come into mind. One, debt is a cheaper source of finance. Two, it is a risky source of finance. If debt is a cheaper source of finance and debt is a risky source of finance, that means equity is riskless and comparatively equity is costlier. Now, how do we actually justify this statement? So, for basic justification, debt is a cheaper source of finance because of two reasons. There are two conditions. If these are fulfilled, then debt becomes a cheaper source of finance. First, that debt has a fixed rate of interest. So, you pay a fixed rate of interest to the person from whom you have borrowed money. Second, this interest is a tax deductible expense, so your tax liability reduces, which is why debt is a cheaper source of finance in comparison to equity. But when we talk about risk, debt is riskier. Why is debt riskier? It is riskier because whether you earn profit or not, you have to pay interest, and second, you have to repay the principal amount. Now, if you have to repay the principal amount, that means you either borrow more and then return, or whichever way it is, you have to give the money back. In that condition, debt gives you a threat of insolvency, whereas equity does not have any such preposition. Equity is without any such kind of risk. It's your money, it's gone forever. So when we talk about capital structure, we need to answer few questions. Again, when we talk about debt, there's a question, why is cost of debt lower than the cost of equity for a firm? Why debt becomes a cheaper source of finance? Now, here, it is so because the lender's risk is lower than that of equity shareholders' risk. Why? Because the one who's given money to you or from whom you have borrowed, he has no risk. Why? Because you're paying a fixed rate of interest to him. Since the lenders earn a sure return and repayment of capital, and also pakka vada of giving the principal amount back. Therefore, they require a lower rate of return. Also, interest paid on debt is deductible expense from computation of tax liability. It is, like I gave you, that the interest, when you pay interest in your net profit, you just show interest as an expense. When you calculate your net profit, you show interest as an expense, which reduces your net profit and your tax liability reduces. Very simple, clear, okay, done. Once you get your net profit, after giving the taxes, whatever money is left, from that money, either you retain that money for reinvestment into the business, or you just simply declare that as dividend. That money after the taxes have been paid is called after tax, money after tax. Okay, so whatever it is you're receiving after tax is what is declared as dividend to the shareholders. For computation of tax liability, whereas dividends are paid out of after tax profit. So that profit, that money after tax is what you declare dividends with. Increased use of debt lowers the cost of capital of the firm, provided the cost of equity remains unaffected. Now, why we're talking about this, I'll just give you an example how it happens. See, suppose in a company there are 10 people and those 10 people have given 1 rupee each. So there are 10 rupees with the firm. 5 people are the ones who have who've lended the money to the firm, and 5 people are one who have actually invested in the firm. So the 5 people are debenture holders, 5 people are equity shareholders. The company gets a profit of 10 rupees. Those with 5 people, they said that whatever so may happen, we want 50 paisa as a return every time. 50 paisa as a return every time, or you fix 50 paisa for us every time there is a profit. We want fixed rate of interest, that is our interest. Equity shareholder says, they say that okay, whatever is left over, give us that. Now the company earns 10 rupees. These people were asking 50 paisa. So all 5 people will get 50 paisa, 50 paisa, 50 paisa, 50 paisa, 50 paisa, that is 2.5 rupees. And here leftover will be 7.5. So those 5 people will get 1.5 each. This increases to 20. These will still get 2.5. These will get 17.5. Okay, that increases to 30. These will get how much? 2.5. These will again get 27.5 and 3.5 each. What is happening? With fixed rate of interest, always the return for the equity shareholder becomes more. So if you employ more debt, undoubtedly that is beneficial to firm, but then there's one problem. If you have borrowed more and equity is less, how will you pay off the people from whom you have borrowed? So increased use of debt lowers the cost of capital. Undoubtedly, if you use more debt, it lowers the cost of capital of the firm, provided the cost of equity remains effective. But cost of equity remains, this is a fictitious situation. It is not possible that the cost of equity will remain unaffected. Now, debt is a cheaper but more risky for a business. Why? Debt is cheaper but more risky for a business because the payment of interest and return of principal is obligatory for the business. It's not told. Any default in meeting these commitments may force a business to go into liquidation, takeover threat. There is no such compulsion in case of equity, so therefore it is riskless. So we've answered both the question, we've talked about this, we've talked about all the things. Next we come to is another question, financial risk. Now I've given you bookish definition out here, but what does financial risk mean? Any default in payment of fixed financial charges is what is financial risk. Financial risk is the chance that a firm would fail to meet its payment obligation like interest, repayment of principal amount, etc. I have not written out here, etc. Why does financial risk arise? What happens? Why financial risk takes place? So sometimes what happens is higher use of debt increases the fixed financial charges. If you're using debt too much, now this is what we're talking about. This is what we increase use of debt. So if you're using debt too much, it will increase your fixed financial charges, interest charges will increase, you have to return the amount, that part will increase of a business. As a result, increased use of debt increases the financial risk of the business. So financial risk increases. One, you have default and you're using excessive debt, both of the things will actually have a negative impact on your business. So conclusion, what does it say? It says capital structure of a company affects both profitability as well as the financial risk. One, and when does a company have an optimal capital structure? It says a capital structure is said to be optimal. Optimal means balanced when proportion of debt and equity is such that it results in increase in value of equity shares. So in case whenever you use debt with equity and there is an increase in the value of equity shares, the capital structure is said to be optimal. So this is about introduction to capital structure. I hope it is clear to you. Basically now we're going to move on to the next topic. We're going to talk about the concept of trading on equity or financial leverage, where we're going to use debt and equity in three different situations, and we'll see how it affects the firm. These questions will be answered with that numerical and it will clarify your understanding. Starting with one of the very important concept of capital structure, financial leverage. If you remember, when we talked about capital structure, we talked about mix of debt and equity. Now to what proportion are we using debt in the capital structure is what we talk about when we mention the word financial leverage. The proportion of debt in the capital structure. Financial leverage is of two types. One is favorable, the other is unfavorable. Favorable is when rate of return is more than the interest. So favorable is when rate of return is more than interest, and unfavorable is when rate of return is less than interest. And how is this computed? It is computed exactly like your capital structure, that is debt upon equity or debt upon debt plus equity, where D stands for debt, E for equity. Alright. So as financial leverage increases, the cost of fund decreases because increased use of cheaper debt financial, because of increased use of cheaper debt, financial risk increases. Exactly the same thing what we are trying to say. Because financial leverage has got two conditions. One, that rate of return should be more than rate of interest, and second, that interest is a tax deductible expense. How we are going to see that? So what we need to analyze out here is we need to analyze that financial leverage has to be understood through the process of EBIT EPS analysis. Now what is EBIT? EBIT is earning before interest and taxes and earning per share analysis. And how it happens, we have a fictitious situation out here where company XY Limited has got some kind of equity, 30 lakh as equity. Then in one situation it has got equity and debt mix, and another situation where debt is more and the equity is less. We have a complete numerical which we are going to solve out here and understand that how financial leverage affects us. So we are just solving and we are trying to understand the favorable financial leverage first. Financial leverage, like I told you, has EBIT and EPS analysis. And with EBIT EPS analysis is what? EBIT is earning before interest and taxes. EPS is what? Earning per share. Suppose company X Limited has total fund of 30 lakh. There are 30 lakh of fund. Interest rate is 10% per annum. Tax rate is 30%. Then earning before interest is 4 lakh. This is all given to us. Now, there are three situations with debt. In first, debt is nil, no debt. In second, debt is 10 lakh, and in third, debt is 20 lakh, and the since the total fund is 30 lakh, the cost of equity is at the rate of 10 per share. Now, condition for financial leverage. There are two conditions which need to be fulfilled. First is rate of return is more than rate of interest. This is what I told you. Rate of return is more than rate of interest, and interest is a tax deductible expense. We need to understand this. How? Situation 1, we have total equity 30 lakh. Here we have equity plus debt 20 and 10 lakh. Here we have equity plus debt. Here equity is 10 lakh and debt is 20 lakh. These are the three situations. Now, this is given to us. It is already given out here. These are the situation which we are talking about. This is the situation along with total fund. So this makes it 30 lakh. This makes it 20 plus 10, 30 lakh, 10 plus 20, 30 lakh. Now, next, we talk about earning before interest and taxes. This is also given to us. Earning before interest and taxes is given out here. Earning before interest and taxes in all the three situations is what? 4 lakh rupees. Now, what we need to do is, as per the equation, first we need to solve that. We need to know how much interest are we supposed to pay. So interest is also again given out here. Interest is at the rate of 10% per annum. Here we deduct interest at the rate of 10% per annum. Since this is total equity, the interest is nil. Equity plus debt. So on debt here 10% per annum. The debt is here we have 10,000 as debt. So the interest would be 1 lakh. Here the debt is how much? It's 20 lakh. Interest will be 2 lakh. Next we get is earning before taxes. EBT is earning before taxes. This is 4 lakh as it is. This is 3 lakh. This is 4 lakh. 3 lakh and 2 lakh, right? After that we deduct tax. Tax is how much? Tax is given, tax rate is given as 30%. Now 30% of 4 lakh is 1,20,000, 30% of 3 lakh is 90,000, 30% of 2 lakh is 60,000. What are we left with? It is called earning after tax. Now what is earning after tax, or you can also call it earning after interest and taxes? So it is 2,80,000, 2,10,000 and 1,40,000. Earning per share, this is what we find after that. Earning per share, the formula goes earning after interest and taxes. It is earning after interest and taxes upon number of equity shares. Earning after interest and taxes is this. It comes here at as it is 2,80,000. नंबर ऑफ इक्विटी शेयर्स 30 लाख की इक्विटी थी. एक शेयर कितने का है? 10 रुपये का. तो कितने के नंबर ऑफ इक्विटी शेयर्स कितने हो गए? 3 लाख हो गए. अगेन सो वी हैड द इक्विटी ऑफ 30 लाख एंड वन शेयर इज फॉर 10 रुपीज़. कितने नंबर ऑफ इक्विटी शेयर्स हो गए? 3 लाख हो गए. हियर वी हैव अगेन इक्विटीज ऑफ 20 लाख. 10 रुपीज़ का एक शेयर है. वन शेयर इज़ फॉर 10 रुपीज़. कितने के हो गए? 2 लाख के हो गए. अगेन थर्ड केस में हमारे पास 10 लाख की इक्विटी है, 10 रुपये का एक शेयर है, तो कितने की इक्विटी का नंबर ऑफ इक्विटी शेयर्स कितने हो गए? 1 लाख हो गए, राइट। सो वंस वी डिवाइड दिस इज बीइंग डिवाइडेड आउट हियर, ये इसको हम डिवाइड कर रहे हैं यहाँ पर, इसको भी यहाँ पर हम डिवाइड कर रहे हैं, इसको भी यहाँ पर हम डिवाइड कर रहे हैं, वी आर डिवाइडिंग ऑल दीज, वी गेट 0.93 here, 1.05, 1.40. What does it say? Wherever there is increased use of debt, जहाँ पर debt ज़्यादा है, wherever there is increased use of debt, the earning per share is more out there. So it says that wherever there is increased use of debt, the earning per share is more out there. The company earns 0.93 when unlevered, when there is no leverage. Lever means, see, whenever we use debt with equity. Suppose this is your that seesaw kind of a thing. This side is debt, this side is equity. Whenever we use debt with equity, what happens is the earning per share increases like anything. Earning per share will always increase. Why? Because with debt and equity it is happening, with total equity it is not happening. So company earns 0.93 when unlevered. With debt of 10 lakh, earning per share increases, but with debt of 20 lakh, earning per share further increases. So what is the reason behind this? The cost of debt is lower than the return. How do we calculate the return? Is we have been given all the things out here. We have been given earning before interest and taxes. We have out here earning before interest and taxes is given to us. This is here. We've taken the same thing out here. Then we have total investment. This is given out here. Okay, this we've taken here. Now earning before interest and taxes upon total investment, which is 100 rupee into 100, sorry, earning before interest and taxes upon total investment into 100, which gives us 13.33%. This 13.33% is more than the 10%. This 10% is rate of interest. This is again given to us. This is 10% again given to us. So I would like to explain to you that this is comparatively what? The return is more than the rate of interest. So with higher use of debt, when you use more debt, the difference between the return on investment, that is your profit, and cost of debt increases the earning per share. This is complete financial leverage. If you remember, while explaining capital structure, I explained you that whenever there is a fixed financial charge, whenever there is a fixed rate of interest, the leftover which goes to equity shareholder is always more. This earning per share will not go to the debenture holders. No. They are getting their fixed share. They are getting their fixed rate of interest out here. उनको अपना फिक्स मिल रहा है यहाँ पर. ये किसका फ़ायदा हो रहा है? ये फ़ायदा हो रहा है इक्विटी शेयर होल्डर्स का. तो बार बार बोलते हैं कि जब कंपनी जो है 0.93 है, जब अनलिवर्ड है, जब इसके साथ डेट नहीं अप्लाई करते, तो खाली अगर आप इक्विटी लगाते हो और सबको बराबर पैसा देना पड़ता है. सो व्हेनेवर यू अप्लाई इक्विटी, यू हैव टू गिव द सेम amount of money to all the people, which is comparatively less. But whenever you use debt, it becomes little more, the earning per share for the equity shareholders, and when you use more debt, it becomes much more for the equity shareholders. So this is what is known as financial leverage, with two conditions. One, rate of return is more than the rate of interest. Of course, this is being fulfilled out here. Rate of return is more than the rate of interest. Rate of interest is 10%, and rate of return we have just calculated here, 13.33%. And second is interest is a tax deductible expense. We have done that. Interest is a tax deductible expense. We have got here, see, tax liability also reduced, and we benefited more. Here the tax liability is comparatively more. Financial leverage. Favorable financial leverage with conclusion. This was a board question, and what board had done was they had not given this point, and children were not able to do the calculation. This was a 6 marks question where 4 marks were for numerical and 2 marks were for factors affecting capital structure. This was not given. So for your information, please get it very clear. Whenever the cost per share is not given, okay, the cost of equity is not given, that is per share is not given, you can either suppose it 10 or you can suppose it 100. Of course, it is in multiples of tens and hundred. Since you are doing your company accounts in accountancy, you are well aware of it. But still, for your information, whenever this is not given, please suppose it on your own and do the calculation like this. There's a fixed formula. You'll always get earning before interest and taxes. You have to deduct interest, and then you have to deduct taxes, and then you have to calculate earning per share. For another thing you must know is that this condition, that the rate of return is more than the rate of interest, should be fulfilled for the favorable financial leverage. Next we'll be doing is unfavorable financial leverage, where we are going to make little changes here only, and I'll explain it to you.